to Basic Ranch Bookkeeping, Session 2. I am Haley Ship. My official title with the Ranchers Stewardship Alliance is that I am our Communications and Outreach Lead. Now, just briefly, RSA is a rancher-founded nonprofit. We got our wheels under us 20 years ago already. The year was 2003 when this just started forming in Phillips County, Montana. Our home base is the community of Malta. We do a whole lot of conservation type projects. A lot of those are based in Blaine, Phillips, and Valley counties. But as we do these educational pieces, they really are for anyone. So we are a progressive group. We've got some pretty big goals. Perhaps the biggest one of all is that underlying assurance of wanting to give ranchers all the tools that they need to stay in production ag and keep ranching, keep good grassland management on the landscape. We do run primarily off of grant money, so that is why this whole event was free for you tonight and last week and next week. If you have any interest in what we're doing, I encourage you to visit our website. That is ranchstewards.org, which Angel is dropping into the chat right now. Two other ways that we're able to bring you this event for free. Number one, personal and or business memberships. Those details are available on that website if you feel inspired. And then business sponsorships. This is the first year that we're offering that opportunity. We want to thank Independence Bank, VSEF Cattle Company, AgriBest Feeds, Montana Livestock Ag Credit, Dr. Ann Johnson, DVM, Ezzy's Wholesale, Bank of Malta, First State Bank of Malta, and Hub International for jumping on to be our sponsors here in the first year. Now to our main event. Some of you joined us last week for Ground to Zero. Where do I start? With Lacey Roberts, FSA loan officer. And if you didn't take part, don't panic. We're now uploading that session. It's already on our YouTube channel, and Angel's got that link that she'll drop into the chat there. Also, I'm going to say subscribe to our YouTube channel because then you'll get notified whenever we do upload new content as well. So you've seen it in our marketing as well as in your workbook. There are two distinct sessions left in this webinar series. Number one, accountants and attorneys learning a new language. That's happening right now. And then next week on Monday, big picture, actionable finances and ranch profitability. Speaking of those workbooks, if you didn't get one printed out, not the end of the world. The main thing with those is that we just kind of wanted you to have a place to gather your thoughts, gather your questions, because questions are going to be key as we work through this process. So if you missed that workbook in your email, Angel is also dropping that link into our chat. It's a nice long link there. It ends in PDF that'll open up the workbook on your screen for you. Now, we've got three presenters tonight. They'll roll through their presentations, and then at the end, we're going to have time for Q&A. So hold on to those questions until we are all finished up. Also, because we do have a rather large number of attendees, we're going to have you go ahead and make sure you turn off your cameras and your microphones. That'll help make sure that we're not bogging down the system. And hopefully, as I talk about that workbook, you've had a chance to go through the first couple of parts of it. We're starting tonight on page 10, a new language, accountants and attorneys. Now, this section, as I said, has three presenters, and it's going to start with Keith Tokerud. Keith is with Montana Estate Lawyers P.C. out of Great Falls and focuses his practice on helping clients protect their families and their wealth and helping business owners plan for the most important financial event of their lives, and that is the transition out of their business. Keith is also going to be joining us tonight talking about entity selection within that framework. So Keith, we'll go ahead and turn it over to you.
Thanks very much. I want to talk about entities, starting with the simplest entity and work my way up to some other entities that have a little more complexity. And I'm going to be talking, of course, about tax issues. We're always talking about tax, but I also want to be talking about what we call asset protection, dealing with liabilities that we can protect ourselves against. And I'm also going to talk about having our entities help us with transition to the next generation. So I'm going to start with sole proprietorships. And a sole proprietorship is simply an arrangement where I, Keith, am setting up a business and I don't have any entity I'm going to form. I'll just start working. It's simplest, it's the cheapest, has the least lawyer involvement, probably, but it also has unlimited liability. Whenever we're talking about liability concerns, the first way we deal with those is through liability insurance. So throughout my talk, every time I talk about liability protection, you're going to want to preface that, reminding yourself that liability insurance is the way we're going to start off. But a real downside of sole proprietorships is that we don't have any protection other than our insurance and insurance does not always pay. So one first idea I want to share with you is converting your sole proprietorship into an LLC, to a limited liability company. And I'm going to talk a lot about that tonight. Limited liability companies haven't been around forever as far as the legal world is concerned, maybe 30 or 40 years. They actually started in Wyoming. They combine the limited liability protection of a corporation most often with the partnership taxation rules, which are generally most advantageous for the smaller businesses that we deal with. So if you're a sole proprietorship, you might want to set up an LLC and have that be the entity through which you operate. You'll have limited liability. And then if you want to bring in your child who's working on the ranch with you as a part owner, maybe a 5% or a 10% or whatever percentage owner, you have the LLC, you can transfer percentage ownership to that child during your lifetime and achieve their goals of having a secure future in the operation and achieve your goals of maybe I'll say welding them to the operation so they'll stick around and it'll work out well for the continuity of the farm. If there's more than one person, you're not going to have a sole proprietorship. You're probably going to start most simply with a partnership. I've included a definition of a partnership here today because I'd like you to be looking at that maybe later on, if not right now. A partnership is an entity where two people as co-owners are going into business to make a profit voluntarily. Very often people do not realize they have a partnership. They never called themselves a partnership. They haven't filed anything, but they're actually going to be treated as a partnership under the law. The main problem with the partnership is the same problem with the sole proprietorship: unlimited liability. Not so good. So that's the bad part of a partnership. The good part is the taxation. Generally, I'm infringing a little bit on Britney and Sally. Their talk coming up. A taxation of a partnership is the most flexible. It allows the business owners to adjust the ownership interest between themselves in the way that makes most sense to them. Very flexible. So that's a good part. Well, any entity that you have, starting with a partnership, you want to have a written agreement. A partnership agreement where you agree what happens if one of you dies, if one of you becomes incapacitated, if you get into a fight and one of you wants to get out. And if one of you is going to get out for whatever reason, that agreement, we're going to figure out how we'll determine the value of the partnership. We'll determine how we're going to pay the person who's getting out so that we take issues off the table that otherwise, when tempers are a little bit heated, could be the source of litigation. We want to avoid that. Another idea is to convert the partnership to a limited liability company. You to have a tax like a partnership, but now have limited liability. There's one kind of partnership that we've had around for a long time that has limited liability to an extent, and that's a limited partnership. A lot of times you'll hear them called a family limited partnership. They were very popular in the 80s and the 90s. You have one person, usually sometimes two, who's the general partner, they run it. And then you have other people who are more or less investors. They're quiet parties who don't have any involvement in the management. And the law says the limited partners, because they have limited involvement, can have limited liability. Historically, the general partners have unlimited liability. So I'm getting ahead of myself here. So with the, help me out here, Sally, going backwards. One more. So with the limited partnership, we have a general partner who has unlimited liability. The law recognized about 20 years ago that we could keep our limited partnership, but we could have it be a limited liability limited partnership. I have two matters right now in my office where we're taking limited partnerships set up in the 80s and we're converting them to limited liability partnerships. Relatively easy to do with the help of a lawyer. And now, not only with limited partners, but the general partners have limited liability. Something to think about. And then once again, if you have an agreement from the 80s where there's a partnership agreement, you're going to want to look at that agreement and make sure it still makes sense given the circumstances that we have right now. A corporation. Many corporations were set up also in the late 20th century, mid 20th century for tax reasons. For limited liability, they're great. Back then, they were great for tax purposes. Unfortunately, the law changed And the traditional corporation, which we call a Subchapter C corporation, is now not so good. We have two levels of taxation in a C corporation. The corporation earns some money after deducting its expenses, it pays income tax on that earning. Then it distributes the money to its owners as a dividend usually, and they also get to pay tax on it. Two levels of taxation. Uncle Sam dealt with that by creating a different type of a corporation called a Subchapter S corporation. It's the same as the C, except only one level of taxation. It's similar to partnership taxation, where the S corporation income and deductions flow through to the shareholders. If you see a transition coming down the road, as Sally and I were talking about with some people just this afternoon, you may want to change your C corporation to an S corporation, because the law says once you've done that and 5 years has gone by, if you sell your business, instead of having two taxes for the sellers to deal with, you'll have one. So that's a very important distinction to be kept in mind as you're thinking there's going to be a transition down the road to look at electing an S corporation status. When you have a corporation, it's very important that you follow the corporate formalities. I could bore you with the story of my first trial where I was a sole lawyer in Kalispell, where we ended up, because people had ignored their corporate formalities, getting a judgment of $1.2 million against a Folsom businessman, which surprised him quite a bit. The law says if you don't follow your corporate formalities, you're ignoring it. The law is going to ignore the corporation. So when people are hounding you to do your minutes, when they're hounding you to keep your corporate money separate from your individual money, they've got a good reason to say that, and you want to keep that in mind. When you have people involved in your business who are not actively involved. So you've got a farm here in Montana, and you've got your daughter and her husband working on the farm, actively involved, and then you've got your son out in Seattle. My first advice is don't have your son in Seattle be a member of the organization that's doing business in Montana. We don't want that brother telling his sister how to run the operation in Montana when all he knows is how to do things in Seattle. But if you must bring in a non-owner, a non-operator, then let's limit their authority to control things in the corporation, if it's a corporation. We do that by issuing non-voting shares. They can share in dividends if they're declared. If there's going to be a dissolution, they can share in liquidation proceeds, but they don't tell the farmer in Montana how to operate. And then again, I've talked about electing Subchapter S status if we think the farm is going to be sold down the road. Once again, if we have more than one person in a business, we want to have an agreement between the owners to deal with what happens if things go awry. In the corporate context, it's a shareholders agreement. Again, Sally and I met with some people today, and we said, before you give any shares to your kids or sell any shares to your grandkids, you want to have a shareholders agreement in place. So if things go sideways, you, mom and dad, or grandpa and grandma are still in control of your operation. You're going to do that by having a good, tight shareholders agreement. You're going to provide that when you give some shares to your grandson, he can't go down to Central Avenue and give them to somebody or sell them to somebody whom you never met, and all of a sudden you have someone involved in your business that you don't want in your business. You control that through the shareholders agreement. And if I have some time at the end, I want to tell you a story about some planning we did for a rancher at Chodo, where we were able to save him taxes by the way we had a shareholders agreement set up. If you have a corporation that is involved in more than one line of business, for instance, it's a ranch and it's a farm, and you've got one child who wants to be a rancher, another one wants to be a farmer, and they don't get along, you might want to go through a tax-free corporate reorganization to separate the corporation into two. Now I come to my favorite entity, a limited liability company. Limited liability company has limited liability protection just like a corporation does, and you can choose how you want it to be taxed. Most often we're deciding partnership taxation makes sense. Sometimes we're deciding that the C corporation taxation makes sense because we're not going to put appreciating assets into that corporation, and we want to get the deductions that only a C corporation can give us. Sometimes we're going to want to have that LLC taxed as an S corporation, but you and your CPA or your tax lawyer can make that decision. Again, usually you'll have it taxed as a partnership. By having a limited liability instead of a corporation, you have more flexibility in terms of the relations between the parties. You have better asset protection because under the law, the creditor is limited to what's called a charging order. They don't become your partner. They can stand in line when distributions come out of the entity to get a share, but they're not going to be telling you what to do. They're not going to be your partner. And the corporate formalities that I was warning you about in the corporate world are not as important in the LLC world. So we don't usually use corporations now when we're setting up entities. We'll use LLCs and then we'll decide how we want them to be taxed. Once again, with more than one owner, we're going to want to have an agreement. In the LLC world, that agreement is an operating agreement. It's very similar to the shareholders agreement. So my planning idea, I think you already understand, I'm going to suggest when you're setting up a new entity, use an LLC instead of a corporation. Often when we're dealing with a farm and ranch operation, we want to have two entities. And one of them will usually own the land and it will lease to the other operation, to the other entity. We have an operating entity and we'll have an asset owning entity. Both of them can be LLCs. We can have the operating entity perhaps taxed as a C corporation. We have the asset owning entity probably taxed as a partnership. And then we'll have the best of worlds in terms of allocating income and expenses between the two entities and end up saving the family tax money. When you have an entity, you want to have limited liability, you want to have tax efficiency. The entity will have a different effect in terms of what happens when the owners pass away. And this has to do with what's called the income tax basis. And I'm going to leave that to Sally and Britney to talk about that. But it's really generally the most important tax issue that we have now, since most farmers and ranchers don't have to deal with the estate tax since we have such a huge exemption. We want to make sure that we maximize the chance of getting a step up in basis so that when the kids whom we left the farm unexpectedly do have to sell, they sell the least, they recognize the least gain, capital gain, and pay the least taxes. When we have an LLC and we have a transition coming up, as I earlier mentioned, we can transfer minority interests to younger family members. We can also do this in a corporation, but again, I'm favoring the LLC for the reasons that I just mentioned. So we're going to have an operating agreement in place before we transfer any ownership, and we're then going to transfer whatever we think the initial tranche should be, 5%, 10%, so on. And when we do that, we are allowing our children usually to become owners now, so they have some interest in the entity. They know they've got a future in the entity. And then the operating agreement will limit who their partners can be, can maximize the chance when day's done and mom and dad move out of the partnership, mom and dad haven't transferred it to someone that our second generation doesn't want to be in business with. I want to tell you about a story where I and some other advisors, a CPA and a banker, were dealing with a rancher at Soto, and he had a daughter and a son-in-law who he wanted to take over the place. His estate at that time was about $15 million. And back then the exemption was quite a bit less than it is right now. They were really worried about the estate tax. So we set up a limited liability company, and then we designed a limited liability company agreement that put a lot of strings on the right of minority owners. And then we transferred 40% of the ranch ownership to the daughter. Then when we make a gift like that, we need to file a gift tax return supported by an appraisal. So we hired someone to appraise the ranch, which came out to be about $15 million. And then we hired someone to say, okay, that's fine, that's what the ranch is worth, but what's 40% of it worth when we have an LLC that has this agreement that limits the rights of the 40% owner? And they said, okay, we're going to start with $15 million, but then we're going to discount that by 60%. What otherwise it would be 40% of 15 million because of the circumstances of having an LLC with a minority interest subject to all these limitations. Well, by that stroke of business, we saved something over $2 million in tax ultimately for that family. as I like to say, not a bad day's business. And in this case, we had no other children. But when we have an LLC, aside from tax, we have a way to deal with the son in Seattle. We can give him an interest in the partnership, but we can avoid his telling the farmer what to do. When we do that, we're going to want to make sure we have an exit plan before we give somebody an interest. We're not going to give them an interest that they can look at the paper and never get any money from. We're going to provide that ultimately, when day is done, that child in Seattle gets some value from what he's received from his parents. And it's maybe going to be over time. It'll be maybe at some kind of a discount, but he's going to get some value. It's not going to be a situation such as we had in the past when we had corporations where the non-farming kids had a minority interest and they never got anything for their whole life from that interest. We don't want that. We want to have a business-like arrangement where if we do need to involve our non-farm and ranch kids in the farm, it's going to work out for them as well as work out for the farmer and the rancher. So those are the entities that I want to talk about. And just to recount what I've been trying to stress to you, there may be tax advantages for using these different entities. There are definitely advantages in terms of maintaining control by the farm and ranching grandchildren. And we can use the LLC or with the corporation, but the LLC to facilitate transfer over time to those whom we want to take over. With that, I'm going to close my part of this presentation and turn it over to the CPAs.
All right. Thank you very much, Keith, for that. And I just want to reiterate for folks, because as Keith is talking, I start scratching my head because I know what we have done on our ranch, but the idea of the other possibilities is completely over my head. And so I just want to say that for folks so that if you are thinking the same thing and you're thinking, what in the heck did I just hear? Or how do I know which one is best for me? I think that two things out of that. Number one is you're in the right place. You're starting to figure out what some of these words mean. It's going to take you doing things like this in repetition before you really get more comfortable with it. And then number two, just making sure, if you were with us when we talked to Lacey last week from the perspective of getting a farm loan, make sure that whoever you're talking to is somebody that you trust and somebody who you can ask these questions that maybe seem silly and kind of make them dumb it down for you, because we are not all attorneys. We didn't pass the bar. So what Keith can give us here in 20 minutes is going to likely be a little bit of a challenge if you're not somebody that's versed in that arena. So I just want to give that little disclaimer. Do not get down on yourself and don't start feeling like it's something that you're never going to be able to grasp, because you're in the right place to get started. And that second piece really is just getting a professional that you can trust. So with that, we have talked to our attorney. Now we're going to walk the walk of the accountant. And for that, we do have the privilege this evening of having two accountants with us from Montana Roots Accounting. They'll be co-presenting. So I'm going to go ahead and introduce both of them. Britney Tempel has been working as an accountant on Montana's Highline for the last decade. She grew up on her family farm near Turner, where she was helping to move equipment just this morning as we were talking, along with her own farming experience. Both of those have provided her with the great ability to relate to her clients. When she isn't busy chasing her two children for activities, Britney enjoys getting outdoors with her family. She's been a longtime presenter at the Montana Next Gen Conference. We highly recommend that. If anybody has not gone to that, we can definitely get you those details. And she is always willing to sit down and answer questions that agriculture tax brings up. Next, we've got Sally Salveson joining us. She was born and raised in Malta, graduated from Malta High School in 2002, and continued her education for multiple years, eventually earning her CPA license in 2008. That was when she moved back to Malta, and throughout her career, Sally has continually focused on serving and building relationships with her rural-based individual, business, and agricultural clients. She serves on various local boards, including the Phillips County Cattlewomen, Arcan, and Phillips County Community Foundation. Sally and her husband, Ken, have 3 children. They ranch west of Malta, and in their spare time, they enjoy activities on the ranch, as well as spending time at Fort Peck Lake. Ladies, the floor is yours.
All right, thanks Haley. I'm going to go ahead and share the slideshow here. So let me know if we end up with any issues. But hopefully this will work for everybody.
Looks beautiful on our end.
Okay. So everyone, I'm Britney Tempel. I am in Turner tonight, as Haley said. I'm originally born and raised here, and I do work from Montana roots out of Joplin, Montana. So we're going to go ahead and get started and lead off a little bit on what the purpose is to a lot of why we're doing what we're doing, why Sally and I do what we do, and I think why everybody's trying to participate in this, and hopefully wrap everything in, tie a little bit into what Lacey talked about last week and what Keith talked about earlier today, in basically, trying to reinforce the whole reason why bookkeeping is a place to get started and something to try not to be intimidated by, and try to ask all the right questions and just get your feet wet. Because the reality of agriculture anymore is the input costs are high. The markets continue to fluctuate in a way that doesn't make a lot of sense. The way the market ends the day before and it opens the next day, there can be significant price jumps. And so if there is any part of the financial or the numbers of your operation that you can control, it's the stuff that we're talking about. It's the stuff Lacey talked about. It's understanding your balance sheet. It's understanding your income statement and your cash flow and trying to make use of those, because that's about as much control as you have over the numbers affecting agriculture as we can possibly get to. So that kind of allows us to help you set some short-term goals for yourself, especially if you're beginning in agriculture, really trying to kind of accomplish a decent amount of things in a short amount of time, and then really set you up to potentially have some longevity, especially if you are the 4th or 5th or 6th generation farmer or rancher. We want to continue the legacy that your family has built. So we're trying to kind of reinforce taking advantage of these opportunities and not being intimidated by it. Like Haley said, there's a lot of operational opportunities and limitations. People are starting to get a lot more creative with farmers and ranchers working together to kind of utilize different practices that we haven't seen in the last couple of years. And so again, kind of understanding where your numbers are and what your structure is and what your opportunities are will help you take advantage of those kinds of things, help you identify what your particular operation has for strengths or where you might be weak. And I know a lot in Liberty County, there's some opportunities that come up just in the last couple of weeks for haying. And anymore, it seems like you have 24 or 48 hours to decide if an opportunity, whether that's a new lease or a haying opportunity or grazing opportunity, if you don't make that decision in 24 or 48 hours, sometimes there's a guy standing right behind you that's willing to take advantage of that. So again, kind of knowing what you can do, what your opportunities look like, allows you to take advantage of some of those things that you might not otherwise be able to do. And it reinforces some knowledgeable decision-making. I had a meeting just last week with a guy that came in and he's got almost 15 years worth of data in his QuickBooks file. And you farmers and ranchers are a lot better sometimes about remembering the years that you had decent moisture and the years that were really heavy in drought. And he was kind of able to go back to some of those years. He remembered getting a pretty decent hay crop and started kind of looking at what this fall opportunity might be for being able to sell hay because the way that things look this year. And so just having that data was allowing him to make some decisions about this fall and what he might do to, in his case, potentially replace some equipment, maybe even buy some of the herd back after he had to cull pretty hard the last couple of years. So again, kind of having that data gave him the opportunity to just go back and look at his numbers and his numbers alone and what his operation's been able to support before. And he couldn't have done that if he wouldn't have been able to kind of step in the doors and get some of those numbers put on paper. And so really understanding the depth of your operation is a huge component for us. It's easier for me to do my job when we can talk in the scheme of where the numbers are at, what the opportunities are for you, what your working capital looks like, what your net worth is. Do you have the ability to finance some operations? And especially with all the things that Keith just talked about when it comes to step up in basis and identifying whether or not it's the right entity, having those numbers and having those goals and things really reinforce and help you make the best decision for your operation. Those are those meaningful professional discussions that you can have when you have a balance sheet and an income statement and a cash flow that you can come in and then we look beyond the numbers. We start talking about what you want for your operation 5 years from now and 10 years from now and how we go about getting there. Like Keith, referred to making an S election and buying yourself 5 years worth of time where you get rid of that double tax. Sometimes it's really important for us to be able to look at the numbers, look at the direction you're going, and look at your dynamic as far as transition plans look like, and grandma and grandpa and mom and dad, or depending if you are mom and dad, what son and daughter are doing. And we just need that whole picture. So those discussions get a lot more meaningful, a lot more reliable when we have some of that data. So Sally and I are going to break this up a little bit. And, you know, like Haley referred to, it's difficult to shove as much information as you guys can possibly need into the amount of time that we have. So we're going to try to just dip toes, create some questions, and give you guys plenty of opportunities to get in contact with either one of us if you have some follow-up questions. But as Lacey referred to, and she got pretty detailed with it last week, you know, the balance sheet, which is the one of the 3 sheets that she referred to, that's kind of that current day snapshot. You know, I can look at a balance sheet as of today. I can look as of December 31st. I can look at June 30th of last year. And either way, the date on the top of that statement tells me the value of your business on that particular day. And so the assets that are on there, those are the things like cash, if you have brokerage accounts, your machinery and equipment, cattle, raised grains that are raised, those kinds of things, those are demonstrated on your balance sheet. Below that are your liabilities. You know, that's the money, whatever you've incurred to buy the assets. So those are short-term and long-term bank loans, your operating loans, your equipment loans, all of those things. And below that is what's referred to as your equity or your net worth or your capital. Those terminologies kind of get interchanged. It means a little bit different things to maybe the professionals on the other side of the table, but in a lot of times when we're having those conversations, those terms are kind of interchangeable. But what it really is the value of all of the assets that you have minus the debts that you have, and that determines how much equity you have or what your net worth is of your business, or even in a personal sense, it can be the personal cash you have, the personal debts you have. What is your personal net worth? That's the result of that math. And that's what we help define as, you know, working capital. Do you have enough cash to pay down this year's debts to continue to finance next year's operation? You know, is your business being able to cash flow itself? What else do we need to do? And really kind of help to understand your farm and ranch net worth. It's a really important statement when you are going in to get your next bank loan. They look a lot about your ability to use the assets that you have, to leverage those assets to make those debt payments. So it's got a lot of value in that balance sheet. It's a pretty significant thing. And those values, like I said, they're a snapshot at a period in time. And one thing that we really want to make sure that you guys understand is, as Keith referred to, your LLCs, your partnerships, your S Corps, your C Corps, they all have different requirements. But anything that is not a sole proprietorship, so the partnership, S Corp, and C Corps, they do have a balance sheet that is part of the annual tax return that gets filed. The important thing is that the balance sheet that your banker is looking for, or the one that your lenders are looking for, that's different than the one that your tax accountant does. And they're different because of this thing referred to as basis. Keith alluded to it a little bit when he talked about having a step up in basis. And the reason that that's important is for us as accountants, we create your balance sheet on what's referred to as the tax basis. And tax basis for cash is pretty easy because cash value is what it is today. You know, and that doesn't change between fair market value, which is what your banker's looking for, and tax basis. Cash is the same. The things that are fairly significant in difference is your machinery and equipment, because for tax purposes, when someone comes in and they will have bought a swather or a baler by the end of the year, or they bought more bulls or cows, we're making decisions on how much depreciation we take a lot of the time based on what their income tax situation is for the year. So we might choose that in 2023, when you buy that swather and you buy a couple new bulls and you've bought 10 head of cattle, we might choose to write that all off in the year of acquisition. If we do that, and if you bought $150,000 worth of stuff, for tax purposes, that's no longer worth anything. You've taken all $150,000 of money that you put into that machinery and equipment and into those cows, and you've taken that full expense in the year of acquisition. So that means going forward, as far as your balance sheet goes for tax purposes, there is no value there. It's zero. Your banker doesn't want to see a zero on your balance sheet. Your banker wants to see what that's worth. So even though we wrote it off for tax purposes, there is some value still left in that sprayer. There's still some value left in that baler. There's still some value left in those cows. So the banker wants that asset listed on the balance sheet, and he or she wants that value at what you could turn around and get out of that equipment or get out of those cattle today. Essentially an auction value. And most farmers and ranchers are pretty good about picking that value because you've gone to enough auctions in the last couple of months that you can kind of guess where those values sit. So that's what they want you to use. For the rest, like I was talking about for us having tax basis, that number, once it's zero, it's going to stay zero. So there's a discrepancy there. The other thing is raised commodities. So for us on the tax side, you are deducting what, if it's farming, you're deducting your seed, you're deducting the fuel, you're deducting chemical and fertilizer as you are incurring those expenses. So we're writing those off on your income statement as we go, which means when the grain comes out of the ground and you harvest it, there's no expenses left to it. We've already written those off. So those raised commodities have no value for tax purposes. For a banker's purposes, those things have value because you're going to turn around and sell them at market prices. So your raised commodity is something that your lenders want to see on your balance sheet, and they usually like to see it listed by cows, calves, steers, heifers, bulls. They want to see it by peas, chickpeas, hay bales, you know, anything that you've raised. They want to see those details. They want to see the quantity on hand and the current fair market value so that you're given the value that you might get at market prices. And that helps. That's the leverage. That's the assets you need to support potentially getting a larger operating loan or requesting an auto loan or a bank loan, because now you are, you know, you're not inflating your values, but you're being very realistic about what your operation is going to have for assets because of the raised commodities you have on hand. So a lot of times when you call your accountant and say, hey, can you send over the balance sheet to my banker? We really want you to understand that balance sheet's not going to be in your best interest because we may have written off all of your equipment. Every calf that you have on the ground is worthless, and there's not a commodity that you've raised that has any value. And those potentially are the largest asset value things that you have. So we want to work with you to create the balance sheet that's going to give you the most leverage possible so that your banker does not turn down your request to extend that operating loan because the values coming from your accountant are fairly reduced compared to the loan that you might be going after. So just a really quick note on depreciation, because some of the things that have come up, some common questions Sally and I've got asked, just note that your option in regards to writing off your assets, that happens in the year of acquisition. And the IRS defines acquired as not just the fact that you put $5,000 down on that new pickup. It's a matter of the fact that that asset needs to be available for use. So it can't be something that you walk into Frontline or Torgerson and put $10,000 down on a new swather and then find out that that's not going to show up till the first of the year. That doesn't give you that write-off. You have to have it available for your use, or it has to be ready to be used by you. So if your initial down payment and then the acquisition of the equipment, those happen to straddle 2 different years, we have a little bit of a problem. So just really pay attention to you having the full acquisition of that piece of equipment. And that allows us to start discussing with you how much we want to take as a write-off in that first year. And the other thing is to note that even if you finance the purchase, even if you financed 100% of the purchase, as long as that asset is in your control and it's yours by the end of the year, we can still write off the full value of that asset. So whether or not you paid cash or, you know, just a $5,000 down payment, that doesn't limit the amount that you're able to write off. We are able to write off the entire acquisition price of the building or the machinery and equipment or, you know, whatever it is that you're acquiring, and all of the costs that it took for you to get it. So if you bought something out of Illinois or you bought something out of the Midwest and you had to pay for it to be trucked to get here, all of the costs that went into acquiring that piece of equipment or those cattle, that's all deductible in the year that it's acquired, and as long as it's in your possession and available and ready for use. So those things are just some things to kind of keep in mind as you guys are going forward. And probably the one other thing that I want to note before I hand it over to Sally is probably one of the biggest mistakes that we've got some beginning farmers and ranchers making is You start with $20,000 in your bank account at the first day of the year, and you get to the end of the year and you have $10,000 in your bank account. And you do the quick math and say, that means I lost $10,000 on my farm or my ranch this year. I don't need to do any tax planning. I lost money. I'm going to be good to go. That is not usually the case, because sometime during the year, there is a really good chance that you put cash towards something that's not deductible. And a loan payment is one of the biggest things that's on your balance sheet that is not deductible. So even when you're doing a cash flow statement, like Lacey said, and you're talking about all of the inflows of cash and all of the outflows of cash, when you take a loan, when you take an operating loan or an auto loan and you get money from the bank, that is not considered taxable income. So your loan itself is not at income. Because that loan itself is not income, when you make a loan payment, the payment itself is not deductible. The interest portion of your loan payment is, but the larger principal portion of your loan payment is not deductible. So if a big thing of what you spent your cash on during the year is making a loan payment or paying off your operating loan, do not be deceived by the fact you started with more cash than you have now, because that very significant operating loan payment is fully not deductible and is very easily translating into some taxable income that you weren't planning for. So when you're already $10,000 behind in cash, and Sally and I have to call and tell you you have a $10,000 tax bill, it kind of makes a really bad day for us. So we would prefer that we have a little bit of a discussion in October or November and December and kind of help you walk through where you've spent your money throughout the year and make sure that we are talking about truly taxable income and we're talking about true tax deductions so that you're prepared before the end of the year to kind of have those discussions. So just one other thing to note about that balance sheet as it relates to a cash flow statement and as it relates to your tax return so that you don't get caught off guard. So with that, I'm going to hand it off to Sally and she's going to do some discussion on more of the income statement related things for you.
Hey, today we're going to talk about the Schedule F a little bit. So Keith started off by telling us that our farm and ranch operations can be structured as C corporations, S corporations, LLCs, partnerships, or sole proprietors. Today we're going to focus on the Schedule F. That is the schedule that you are going to include with your tax return if you are a sole proprietor. But really, the income and expense items on the Schedule F can apply to the farm schedules you'll see in the corporate income tax returns and the partnership income tax returns. So a lot of this will apply either place. So, you know, what is the Schedule F? Who files the Schedule F? It's the form that we file when you are actively in the business for profit of raising and growing agricultural products. Farms and ranches usually file this return on a cash basis with a Schedule F most commonly. Cash basis meaning you report income when you receive it and you report expenses when you pay them. So you might get, say, a utility bill in December that's for December service, but if you pay it in January, you don't get to include that as an expense until next year. Something that might be a little bit of a misconception to note is just having possession of a check is includable taxable income in the year that you receive it, even if it didn't make it to the bank. So yes, one of the greatest things is when clients come in and tell us, well, I didn't put that in the bank, so I don't have the income, but I got it before the end of the year. Well, that's not quite how it works. But we're going to just focus on the cash basis today. So just going to kind of run through these categories quickly and kind of try to bridge what Lacey talked about last week with the budgets and you know, the schedules that the banks use and some differences on the income and expense side of things where it translates from the bank budgets into the tax return items. So it's kind of running through the Schedule F. On the first part, we've got our income. Line 1, sales of livestock and other resale items. This this is for when we're purchasing commodities for resale. If you bought calves at the end of the year, you're planning on selling in the spring, feeder calves, things like that. That goes on line 1, we've got our sales and then our costs. Line 2, our sales of livestock. Really think that's kind of the focus of the Schedule F, the sales of livestock, produce, grains that we've raised, our calves, our grain, our wool, things of that nature. And then these first 2 lines really are where we might find our first difference between a bank budget and the tax return. On these lines, there are certain instances where we're able to defer income or do different things with income. The drought the last few years, because we've had, federally declared disaster, we've been able to make some elections where if ranchers have sold animals they normally would not have sold because they had no feed, no water. We can make an election, even though they've received the money, they have the cash in the bank. We can make an election to push that income into the next year. So that might be, one difference between what you're handing to the bank and what you're reporting on the taxes. Can also go the other way. We can, during planning, it's looking like you might have too much income, and we're going to tell you that you might want to look at doing a deferral contract on the calves that you're selling in the fall. You're not actually going to receive the money. You'll push that into the next year, have that held somewhere else, and then move that off of your income statement. When we get to the end of the year, sometimes we might find that you actually spent more than you needed to, and you could actually have taken that income in. We can pull that back into the tax return, even though you haven't received the money. And then we have some income where we might have too much next year. We can use it this year. Some other lines on this income part, cooperative distributions. A lot of producers are part of a egg cooperative that helps market their products. We see this a lot in farming, say with CHS that are helping market the grain. In the ranching world, we might see this more for input costs, with feed, fuel, and you might be getting a return. And so we report that on this income statement here. Our egg program payments, it goes on the schedule as well. Just want to plug the pandemic assistance program that's out right now. If you haven't been into the Farm Service Agency yet to ask about this, you might want to. Think we have it till July 12th or the 14th to apply for this program. And what do they ask you for? Your Schedule F. They use the information from that for this program. We've got a couple more farming related items, the CCC loans, crop insurance. Both of those have different provisions where we can make some deferrals in different elections to include income or not. So just another difference between that cash flow statement and what we're seeing on the tax return. And then we've got custom hire. If we're not in the business of doing custom hire work, but you're farming, ranching, and you swap your neighbor's field just for some extra income, that's what goes on our custom hire. And other income might include fuel tax refunds, rebates, other miscellaneous refunds, and things like that. And before we roll to the expenses slide, I just want to note too, Lacey talked a bit about the chart of accounts, and I know that John next week is going to talk about this as well, but using the Schedule F is a great place to start. And I think Angel posted the link or the PDF of the full Schedule F. But if you are, getting into your bookkeeping software and trying to figure out how to set up your chart of accounts, this is a great place to start. It has the main categories of income and expenses. There's definitely some other items that are very common that aren't on here. But just getting a start with these items, this income, the expenses that we're going to see on the next slide, it's going to be consistent with most schedules that banks put out there. It's going to be consistent with the items that FSA asks for when they're asking you to fill out their forms. And between those things, if you're really starting to get where you're looking at comparisons, looking from year to year, I think it will pull everything together to have this data consistent among all three of those things. So we'll kind of roll through some expenses quick, and then I know we'll do some questions. Again, just kind of noting that some of these deductions are different based on different structures. So Keith talked about some corporate types of structures, and most notably, we see a lot of differences in meals, housing allowance, things like that, as far as corporations versus the Schedule F. This is another form in which this schedule on your tax return is different from your bank budgets. Your accountant may be taking percentages of certain things. We may be taking a percentage of your vehicle expenses, your housing expenses, to allow for personal use that's not allowable on the tax side of things. One other thing we want to mention too is the most important determination here is your expense a qualified tax deduction. You might get hung up in, well, is this a supply? Is this a repair? Is it chemical, fertilizer, spraying, custom hire? The IRS is going to care a lot less about which category you put it in, as long as you're consistent, you know, as they are about making sure you're properly deducting the items that you should and not deducting the items that you shouldn't, and that you have proper support and documentation to back those items up. So don't get overwhelmed. Don't get worried if you're trying to decipher a CHS bill, thinking, you know, which do I put in which category. Consistency is the key. If it's in one spot, your accountant can lead you in the right direction. If you've gone very far astray, at least it's all in one spot. We also like to see the Ask My Accountant accounts used. It's a great spot to put questions. A lot of times people will change that to ask Britney, ask Sally, whatever it might be. We can pull it out and talk about it, just to keep you moving along, get your reconciliations done, keep moving throughout your month. So on our Schedule F, we've got car and truck expenses, chemicals, conservation expenses. These have some limits. We won't go into too much detail, but could be a difference from the cash outlay there. Got our custom hire. Custom hire on this line, not to be confused with actual payroll and labor hired, which is down on line 22. So custom hire is, you know, hiring a contractor you're not intending to employ full-time and give a W-2 to at the end of the year. Britney talked a little bit about depreciation. The annual expense goes here on our profit and loss schedule, the non-cash expense. So again, not in line with our bank budget, but this is the portion that we're depreciating this year. We can deduct employee benefit programs on our Schedule F. This does not include benefits for the owner. So this is benefits for your employee, like health insurance, things like that. Owner's health insurance, that goes on a different spot on our tax return. We got our feed, fertilizers, freight and trucking, fuel, insurance. This is other than health insurance, so your farm liability, vehicle insurance, things like that. And Britney talked a bit about the loan payments not being tax deductible. What we can deduct here is our interest expense, whether that has collateral against it or it's our operating loan interest, which is great. Got our pensions, our rents. Here's where repairs and maintenance, supplies, these things come into play, where they could definitely go either way. I think Lacey had a great point of you know, adding a small tools account. If you're just not sure where to put it, a small tools account is great. One thing to note about taxes, this does not include all taxes that you pay. We can't deduct income taxes that you pay on the Schedule F. This is for real estate taxes for your farmland or ranch land, per capita fees on your cattle, vehicle registrations, equipment, licenses, things like that. Utilities, we might be taking a % of based on the personal use. So just something to note. And then of course we have our vet expenses. We'll go to the next slide and talk about other expenses for a minute. So some things that aren't on here that are really common, we've got advertising, promotional, what you think might be a charitable donation, might actually be advertising if you've donated $100 to RSA for, a certain educational program. It's probably some advertising for your business. Bank charges and fees, very common here, dues and memberships, your legal and professional costs, any travel or education that you're doing, and then meals and provisions. Want to talk for a second about meals. For 2022, we had a special rule where meals provided by restaurants were 100% deductible. That's going to go away in 2023 as far as we know it. It didn't have to be on premises at the restaurant, just needed to be purchased from a restaurant. And this might be a place where subcategories might be helpful. And I think it's something that we miss, quite a bit, just because it's usually lumped into one category. But if you're providing a meal on your farm or ranch for an event for your benefit, such as branding meals, harvest meals, those are going to be deducted at 100%. Meals, typically, aside from the special rule in 2022, while you're traveling out of town, away from home, those are normally going to be deductible at 50%. So you might, think about doing a subcategory to separate out those meals that you're providing on the premises for those events to make sure we're capturing that 100% deduction. The note on here about business meals requiring the receipt, I think it's kind of a good place to mention that that's important for all of the expenses. So the IRS says meals over $75 require a receipt or documentation. However, regardless, the IRS still wants the date, amount, name of the restaurant, and details, so you might as well just keep the receipt. And the same goes for all of the expenses that you are deducting on your farm and ranch expense schedule. Yeah, okay. So what is on your cash flow budget that might not be on your Schedule F? We can't put personal and living expenses. I think Lacey did a great job of talking about the expenses, allowing for the living, but that doesn't go on your tax return. We can't deduct those things, such as vacation properties, boats, luxury autos, things like that. Something else that we get a lot is what happens if I donate cattle to beef into schools, something like that. It's the answer is kind of odd, but basically what happens is you don't get to report the income, so that's your deduction. It's kind of funny, but if you gave cash to an organization, the only way you get a tax deduction for that donation is by itemizing your deductions rather than taking a standard deduction, and this is something separate from your business deductions. This isn't more in the line of general deductions. So most of the time you actually don't get any benefit from donating cash if you're not able to itemize deductions. This way you get to reduce your business income, which means you don't pay as much self-employment tax or income tax. So it is a benefit, although it doesn't really seem like it's a benefit. So I think we'll just kind of leave the other things on that slide for your reading. We won't really go over those in too much detail. And then just to touch very briefly on self-employment tax. So once we get to the end of our profit and loss Schedule F, any profit that is showing on that schedule is going to be subject to Social Security taxes, self-employment tax. This is your payment into the Social Security and Medicare system. This is a good thing. We want to have some of that in there. We want to make sure we have enough credits to get us benefits in the future, but it can add up rather quickly. When it starts to become an issue, when our taxes start to climb really high and it's much higher than we want to or can afford, then we look at those different entities and those different arrangements where we can do some different things to save some tax. Something that is unique to farmers and ranchers is if we actually end up with a loss on that Schedule F, we can make an election to pay into Social Security tax. That gets the credits in the system, not only for that Social Security, but also for disability benefits if needed. Farmers and ranchers have the option to make this election every year if we've got a loss. It also, when this happens, basically creates kind of a fictitious income, which allows you to qualify for the earned income credit, which is also a really big benefit. So you may even end up offsetting all of your Social Security self-employment tax with earned income credit in certain instances, which is pretty neat. And then we've just got notes for you on what the tax rates are. Montana up to 7% gets there pretty quickly. So generally we can figure a 7% tax there. And
Yeah,
I think
Haley, oh, sorry.
Yeah,
I was
go
gonna say,
ahead.
hey, that's kind of the end for us. So if you want to see where we're at with some questions, we can kind of go from there.
Perfect. Well, we've got a couple that people have asked along the way, and I think that these two are mainly towards Keith, but at that, I know that the accountants may have some insight as well. That's not just a simple, straightforward question always. So we had a question from Dale and Janet, and they wanted to know what values you all see in a family trust.
Well, I'm not quite sure what they mean by a family trust. We do estate planning for farmers and ranchers. We're advocates for people with larger estates to look at a will substitute called a revocable living trust. And within that revocable living trust, when one spouse passes away, they'll generally leave their half of the estate to the surviving spouse. And in our planning, in our office, we call that a family trust, where we say it's primarily for the surviving spouse, but also the surviving spouse is usually the trustee. He or she can also designate part of the proceeds to go to descendants, at least. So that's what I mean by a family trust. There's 100 different kinds of trusts, so I'm not sure what besides that the questioner has in mind.
I'm just going to kind of dovetail on that one, Keith. So with my family, we've been looking at this, and there's discussion about irrevocable versus revocable family trust. Do you have any thoughts there?
Well, revocable is nice because we never know what's going to happen tomorrow, much less 10 or 20 years from now. So generally, the planning that we do for people is revocable, changeable, but there can be reasons to do irrevocable trust. So I met this morning with some ranchers who are concerned about Medicaid coming in and requiring them to use up all their assets to deal with the disability of one of the spouses. Well, in that case, there's a strategy we can use involving an irrevocable trust where we'll say mom and dad set up an irrevocable trust and transfer their assets in there, and the children are the trustees and the beneficiaries. And then later on, if mom and dad need some Medicaid help, they can get that without the farm that they had earlier put in the trust being a problem. So that kind of irrevocable trust, to me, is a very good kind of planning. Then if we have people who have very large estates and we're trying to reduce the amount subject to the estate tax, an irrevocable trust can be a way to do that. There's one that we've used primarily in the last couple of years called a spousal lifetime access trust, where dad sets up a trust where mom is the trustee and one of the beneficiaries, but dad is able to use his exemption now of almost $13 million. And mom is the beneficiary of the trust, but she's not going to be taxed on that when she passes away. So irrevocable trusts largely have to do with asset protection and income and tax minimization. Most people, and I think including most farmers and ranchers, are not really going to be candidates for irrevocable trusts.
Okay. We've got another question. This one is from Alicia and asking, what are your thoughts on a holding company?
Do you have some thoughts on that, Sally?
I'll let you take that one, Keith.
Well, I guess the typical Montana farmer and rancher is not really in the business of setting up holding companies. So I can't say I've dealt with a holding company once a week for all my career. But if we're talking about setting up an entity that in turn owns other entities, we're usually doing that for tax minimization, or we're trying to separate out interest from parties who really shouldn't be in business together. So it's maybe a good strategy, possibly from a tax standpoint, or maybe from a family politics standpoint. Beyond that, I can't really make any comments.
I will say in the sense of splitting out different activities, we do see that every so often where we might have an LLC with some sub LLCs with different activities in those, but it's all coming up under the umbrella of one entity, and those are for various reasons.
And you know what, I want to make a comment. When I was talking earlier about the entities, one thing I did not mention is that the entities that have limited liability, like LLCs and corporations, they also limit the payment limitations that you can get. So when we're doing this kind of planning, we want to also be thinking about FSA rules. So we might want to use LLCs, but to make sure we can use get more than one payment limitation, we might have a general partnership made up of 2 LLCs so that we're able to get 2 different payment limitations. So that's a holding company arrangement right there, I guess.
Well, and I know we've run into a couple situations, more from a personal holding company standpoint, where we have C corporations that are looking to convert to S's, and the parties that own that C corp are maybe a little bit behind in the planning. They make that S election relatively quickly, and then they decide that the cattle they own, the machinery and equipment they own, the land they own, they're all going to lease it out. They're no longer going to be actively engaged in farming and ranching. And sometimes we have to be very cautious about that transition, the speed of that transition, and the difference between passive activities and active activities. Passive being when you're no longer actively engaged in farming and you've moved to Arizona and you've leased everything out. And so your C corporation is electing an S, and you kind of have that window. And the cautionary tale there is if you become what the IRS would say is a personal holding company, where you have those assets, but the majority of your income is from rent and you're no longer actively engaged, it changes your tax rate, and it changes some things to be designated as a personal holding company. So that, it may be a little off topic, but just another thing that if we are talking about transitioning your entity and transitioning your operation, know that there is an active level of income we need to make sure you're maintaining, so we don't change what you're being viewed as by the IRS's standards.
So this question, I don't know how many people can relate to, but very often I've seen that a lot of producers like to spend down to 0 income so that they can limit their tax liability, but do it in such an excessive manner that it may be at the detriment to eventually Social Security. Sally, I think you kind of discussed this to some point. Is there a rule if somebody knows that, hey, we've been doing this in the past, we realize that maybe it was a mistake? Do they look at, is it the 3 best years, the 5 most recent? How does that work for Social Security?
So as far as getting credits into Social Security, the Social Security rule is that you need to have 40 credits into the system to be able to qualify for benefits. Beyond that, your qualified income that you earn that's subject to the Social Security is going to increase your benefit. So yeah, if the other thing is, I think disability is just as important as the Social Security to remember. That disability benefit depends on your age, but in general, you need about 2 credits a year, say, to get that disability insurance. So we, I guess, in our practice, have traditionally watched for that Social Security income to make sure that everybody is getting the credits they need into the system. And if they're not, we're recommending that they take that optional Social Security self-employment tax option and paying in so that they get those credits, stay in the system, have some benefit when they retire, and still stay eligible for the disability. So it's something that we watch on every tax return.
And folks, just a reminder, if you do have anything that you'd like to ask of our speakers, just drop that into the chat and we'll get it across there. Keith, you had said that there was a story you had wanted to share at the end. Am I surprising you with that?
Well, no, and I thought I was going to go way over, but I found I had some time. So the story I wanted to share was my Shoto rancher, who had the daughter and son-in-law who we wanted to transfer the ranch to, but faced an estate tax liability. And we were able to save probably something like, I think it's like $2.3 million of estate tax when he passes away by setting up an LLC with an operating agreement and transferring a minority interest to his daughter during his lifetime. That was the story I wanted to share.
Yeah, that was a good paying afternoon, I'm sure, for them. More than an afternoon of work. But we did have an additional question about how much money is needed to be paid in to get a credit with Social Security. What does that credit actually mean?
So yeah, good question. This has actually gone up quite a bit with inflation the last couple of years. We would, in a corporate type of environment, often recommend that our clients pay at least $5,000, and then it was $6,000 for a long time because it was about $1,500 a year to get that one credit in. So say $6,000, you get your full 4 credits. That has gone up. So we have had a lot of corporate clients who are still paying that $6,000 wage that we've had to remind or try and catch that we need to make sure that this is increased. I think it is 1,650-ish to get that full credit now. So it has gone up quite a bit.
Yeah, and remembering that 1,600 that Sally just referred to, that's 15% of the wages. That's the tax that you have to pay in. So your wages have to be, obviously larger so that 15% is the tax that you're paying in. So.
All right, well, I'm not seeing any more questions. One that came to my mind, and this was as you were discussing the changes in meals and the changes with the business meals from 2022 to 2023. I mean, that's not a huge change, but one that I know a lot of folks in agriculture do take advantage of. Are there any other big changes as we're coming out of the pandemic, as we're looking at taxes for this year, maybe next, that people should be aware of?
I would say one of the changes that comes in for 2023 that we are a little mindful is net operating losses. We used to be able to carry a net operating loss forward. And so, for example, with our farmers and ranchers, right, we're always looking at that ability, like you said, that sometimes they they spend enough that we zero things out at the end of the year. Sometimes we end up with losses. And especially in the last couple of years where we've had ag program payments that have been higher due to some of the CFAPs and the just the COVID funds and stuff that have come in, we've deferred crop insurance for a lot of our farmers. We do have deferred, like Sally was saying, some people had additional culling that they had to do, and in some cases elected to defer the income from those cattle. So a unique situation that we're in is that we do have income that has been deferred to future years, but we are now to the point where the tax code is limiting the amount of loss that we can take in these future years. So we're only allowed to take the loss up to 80% of the taxable income that you have in this year. So even if in 2022 you had a loss, you didn't pay an income tax, and we are carrying that loss forward, let's say, for example, that loss was $100,000, you don't have $100,000 of a hole to fill in 2023 per se. What it comes down to is we have to figure out what your 2023 taxable income is, and you can only use the loss enough to offset 80% of that. Does that make sense? So again, if your income's 150, we can use all 100,000 of that loss. But if your income again is 100,000, you don't get to wash that out. It will not be a zero. You will have $20,000 of taxable income. You do have $20,000 of that loss remaining going into 24, but you will have some taxable income this year. So just from a planning perspective, something to think about. If you had a loss last year, we do have some limitations there. And the other thing is that bonus depreciation, which people got used to, allowing you to write off the full use of your assets that you're acquiring, that's also being limited to 80% of the acquisition price of that asset. So we still have Section 179 that we can use, but there's just some different decisions that we kind of have to make in regards to the year-end tax planning. So those are two big changes that are effective for 2023.
All right, from Keon and Billy, we've got, how does leasing the place from the older generation look with an S Corp? Are there tax issues or corporate formalities?
Well, certainly there are going to be corporate formalities. There are going to be formalities in the sense that you better have a written lease. And the lease ought to be not one that you did 15 years ago that's on 2 pages. You need to really have an agreement that reflects the economic reality of it. But I'm going to leave the rest of that to the accountants.
As far as, I'll roll and then Brittany, I'll let you take a turn, but as far as the structure, if we're talking about maybe an S corporation as the operating entity and the older generation maybe owns land outside of a corporation, this structure is great. We can, if the older generation had the S corporation and they're able to gift or sell shares in that corporation to turn over to the younger generation, that's fantastic. If we're talking about land held inside of the S corporation, we may be able to look at setting up something else for the new operation, and leaving that land in the S corporation, or maybe there's a possibility of doing some more tax planning to make a shift there. Brittany, I'll let you follow up on that.
Yeah, I think like Sally said, for tax purposes, it really kind of depends the direction of that and whether that S Corp's been in business for a long time or not. But when you get to that point in your transition in the operation, when you're looking to start leasing things from mom and dad, I think that's the point in time where we like to have that discussion, as Keith alluded to, having an LLC for that outside operator to make sure that we're protecting whatever level of operations that he's got going on. And also kind of trying to keep in mind, if that lease is the direction that mom and dad are going to start doing their retirement, making sure the S Corp and everything else that's inside that S Corp, that they have a plan to kind of maybe transition some of those other assets as well. So I would say it's not overly complicated as long as there's a written lease and both parties understand it's income for one, it's a deduction for the other. Those things are pretty straightforward. But in your professional sense, when you start talking to us about those things, we start firing on a few other cylinders on what other opportunities do we have and other discussions that we should be having now to make sure we're proactive about different transitions of things that you can do with machinery and equipment and the other things being owned by that S Corp.
All right, accountants, in a perfect environment, how often do you want your ranchers to be talking to you, and what times of year?
Often, every time they're making big decisions, and preferably at least a little bit before they made it. And I think the thing that is the probably one of the more frustrating is I had somebody call in and they said, well, we're going to do a 1031 exchange. And I said, that's great. Who do you have facilitating it? No, we already sold it. We just want to do a 1031 exchange. And it's like, okay, well, here's part of the problem. In order to do the 1031 exchange and have that tax deferred, you have to be with a company prior to selling the first property, and you have to make sure that you've hit all the timelines and the deadlines on acquiring the new one. And if you're calling me because you've already sold the first and you're halfway through acquiring and you're just wondering how to do this tax-free, we're too late. And those things are really, really hard when we start getting into the numbers, and all of a sudden we're like, hey, we see a earns money that went, in, did you buy something new? Oh yeah, we're working on buying that stuff from mom and dad. And so it's only hard because we get limited in how helpful we can be and how strategic we can help you be. And sometimes that just creates that environment where the taxes really become a component that we might have been able to avoid. And not to say that we're not, like we enjoy having creative conversations, but the creativity and the ability to strategize and make the best option, present you with the most options, that gets pretty minimal if we have a pretty short window, and or what we're talking about happened last fiscal year and we're in the middle of March trying to do your tax return and it happened last year. So certainly it's not something where I think we need to be having conversations every month, but if you are doing something in which your operation's potentially going to change, or you're looking to bring in a whole nother segment or get rid of something, those kinds of things, even just a quick email or a phone call, is there anything I should be considering? At least we can kind of catch, because sometimes, selling off a large segment and trying to, I'm going to call heavy, but I'm going to go buy this. Those don't necessarily always mesh really well and get you the tax savings that you're looking for, because sometimes maybe there's a self-employment component to one that's not there on the other, or we end up in 2 different years. So again, just making sure that we give you all the information ahead of time so you don't get caught off guard. Those things would be nice, and proactive planning, at least if it's once a year, if it's sometime between October and December, we can help you try to have a little bit of time before December 31st to make some decisions, so that you at least have an expectation of what taxes are going to look like prior to us calling and having bad news.
All right. Well, we've got one final question here, and then we'll wrap things up for the evening. But it is Bobby, and I think, Keith, this question is going to be for you. Where the land is owned by one corporation and the assets are owned by the other corporation, how do you go about getting the next generation involved? So have you seen that? Have any suggestions for how people can manage that?
Well, so we have 2 entities. One of them owns the land, one owns other assets. Generally, the one that owns the land has a lease agreement with the one who has the other assets, which is the operating company. That's quite common. The step up in basis issue that we've been kicking around here a little bit without going into a lot of detail means that the assets in the asset owning company, we want to have that structured in such a way where we can get a step up in basis if that's going to be possible. And other than that, the operating company is where we're going to be doing our work, but it doesn't usually have a high asset value. The value of the company is not as great as the value of the land. So I want to be focused on where the greatest value is and be focusing on getting that land transferred in a way where we're going to have the control that we want, but at the same time be minimizing taxes. So I had this matter, this was a year or 2 ago, where the kids, I'm calling them the kids, they're in their 40s or 50s, they wanted to get that operating company under their control. And the operating company was worth about $1 million, but the land was worth about $10 million. And I said, you need to be thinking about that $10 million assets. That's where you're going to get some real value out of this. So I think it's just a matter of sitting back and looking and see where we can do the best, get the best bang for the buck.
All right. Well, Sally, Brittany, and Keith, thank you so much for joining us this evening. And we'll wrap things up, but I just wanted to say thank you from the Ranchers Stewardship Alliance for giving us this hour and a half. Of course, there's been a lot of prep time going into it as well. So we appreciate you sharing your expertise.
You bet.
Thank you.
Thank you, guys.
All right. Well, as we do get things wrapped up this evening, thank you for your attendance. We'd love for you to be able to join us again next Monday. We'll be kind of wrapping everything up with John Haskell. He is with Ranch Right LLC, and you've got homework. So if you have got your workbook printed out or up on your screen, you'll notice that again, after this week's presentation and notes, we have your weekly homework page. So I'm trying to keep everybody a little bit more accountable to what they're doing with this, because I know that that's what I need, is a little bit of accountability. And as you write things down, it's always a little bit easier to keep yourself on task. So you can cross off Monday. We already did Monday evening. That's webinar. You've got 1 day down. And also, as a reminder, we know how busy it is this time of year. It's just hard to pick any time of year really that will work for everyone. So all of these sessions are recorded. They're available on our Ranchers Stewardship Alliance YouTube channel. I should have this one up in the next couple of days. And the first one is already there, as we addressed earlier on tonight. If you can subscribe to that YouTube channel, you will get notified of the latest content. And then I'll also shoot this email over to our email list for this webinar series, so that you can get the PowerPoint presentations that we've seen this evening, the links that are applicable, and then also that link to the YouTube channel. Once we're done with all 3 weeks of webinars, then we'll mail out a review so that you can let us know how you liked this event. And so if you've got any feedback, good or bad, make sure to keep that in mind for a few weeks until we get to that point, because we want to keep on improving what we're able to provide to you. So with that, thank you everyone for attending. We hope to see you next week. Same place, same time, and I'll send you a reminder on Friday. Have a great evening, everyone.